Hello, welcome to our quarterly update call today. My name is Matt Welling, and I'm a member of our client partnerships team here at Axiom Investors. This will be the first time we've done our quarterly call in this webinar format, and our hope is it'll be something you'll put on your calendars going forward, where you can gain some insight from our portfolio managers and analysts. Before I begin, just a few quick housekeeping items. Please read the compliance disclosures found at the beginning of the presentation. You can also find those disclosures on our website. Today, we expect to have about 30 minutes on our call of prepared remarks, followed by about 15 minutes of Q&A from the participants on our call. If you look at the top of your screen, you can see the button for Q&A, and you're welcome to send through your questions at any time. I'm really pleased to be joined today by Andrew Jacobson. Andrew is Axiom's founder and CIO. Axiom was founded in 1998, and we have steadily built our employee-owned firm to $19.5 billion in assets and 60 team members. Since inception, our investment team has employed a forward-looking, dynamic growth philosophy and process focused on investing ahead of the curve. We had a good year in 2021 and are extremely thankful for the trust that our clients continue to place in Axiom. This year, we added 70 new accounts across all 11 Axiom strategies, and new and existing clients added over $2 billion in new flows. We also launched our first new product since 2014, which we're really excited about, our new global small cap strategy. I won't try and go into all the details on this call, but as a brief overview, we've been managing dedicated small cap strategies since 2004, and the new global small cap strategy is a natural extension of our product offerings and leverages our existing teams and research coverage. Lastly, like most of you, we have been navigating this past year successfully through a hybrid work environment, and it has been wonderful to be back together as a team in the office. With that as a backdrop, maybe we can start diving into the markets and strategies, which is why we're all here. Andrew, I'll turn it over to you. Andrew, you're on mute.
Thank you. Thank you, Matt, and thanks everybody for joining us today. It's a pleasure to be with everybody. I'm going to jump right in. We've got a lot of material to cover. Kristen, is it possible to display the images so I see it on screen as well, or hopefully everybody sees it? Do you see it, Matt?
I do.
Okay, all right. So look, we've got three big topics to cover, just to jump right in. First and foremost, current environment, obviously inflation on everybody's mind, the outlook for 2022, growth, style rotations, growth versus value. Then we'll touch on Axiom's performance in 2021. And finally, I think a topic that's very much on everybody's mind as well, which is the opportunities in ESG, and specifically something that really differentiates Axiom as a growth manager, which is our active approach to advancing positive change as an incremental alpha source within the portfolios. So with that, just to talk about the first topic, current environment and outlook for 2022. As we all know, and particularly with today's inflation print, the 7% headline number, inflation concerns are really everywhere. And what you're looking at on this slide is just, on the one hand, in orange, the number of daily mentions of inflation. So you can see that inflation, the top of mind, and at the same time, inflation sentiment has really collapsed. So people have very pessimistic outlook for inflation. Specifically, and today's data point, and we'll get into the outlook for 2022, the expectation for 7% or 7% plus was as high as 7.2, 7.3 just a few days ago. December CPI print, which we've now seen this morning at 7%, has been very universal and really reflects a combination of forces that have been building really throughout the course of 2020 and 2021. So what you're looking at on this page is a disaggregation of inflation. So you can see the different components, and you can see that the big drivers of inflation have actually been goods in bright green. So, and again, this morning, if you look closely at what drove inflation today, it was used auto prices and apparel. I'll talk more about the supply chain issues in a moment, food and energy. And as we'll see in a moment, the leading indicators. Inflation itself is a lagging indicator. The leading indicator, the inputs to inflation, are already showing some signs of moderation that's got very important implications for nominal growth and for sector rotations over the course of 2022 and beyond. So just one implication, though, of the high current level of inflation and the Fed's response to it after kind of dragging their feet, finally acknowledging, these current inflationary pressures. And so consensus now embeds over 3 rate hikes. Actually, it was nearly 4 rate hikes before today's print. It got up to 65-70% consensus expectation for 4 rate hikes in 2022. That's slightly backed off since the print and since some other data's come out. But that's what's embedded in markets. And so if in fact the actual pace of hikes is in line or less than that, that could actually represent a positive surprise from here. So talking a little bit more about the environment in 2022 and how macroeconomic growth is likely to unfold. 2021 was exceptional. We had exceptional tailwinds from both monetary and fiscal policy globally. And as a result of that, and this is global, so we're looking globally at world growth and world nominal growth, which is the combination of real growth and inflation, which is the basis for corporate revenues and earnings. So we had basically a 25-year high in world nominal growth in green. So that's the combination of the real growth rate in blue and then world CPI in gray. And so those together represented that 10% plus nominal growth rate that really fueled some of these cyclical recoveries and some of the sectors that were really disrupted in 2020 by COVID and then were lifted by this coordinated global policy tailwind. Those policy tailwinds are already ebbing. Some of the reopening effects will ebb through the course of 2022. And so you'll see global nominal growth progressively decelerating, not to levels that are problematic. It'll still be, broadly speaking, above trend. So supportive for equities and for corporate earnings, but no longer the kind of tailwinds that really lifted some of these cyclical sectors. So just diving into the data and the recent data a little more granularly, what you're looking at here on the left is an analysis of what's actually happening with monetary policy globally. So the US tends to really dominate a lot of investors' thinking, but of course there are many other banks around the world, and the global rate cycle actually started last February, believe it or not. And so when some of the emerging market countries beginning to lift rates, there have been over 90 global rate hikes over the last 12 months. And so when the Fed, presumably joins the tightening cycle in March, it'll be more than a year after that cycle began globally. And so if you look at global short rates, this is GDP weighted, they've actually moved up from negative 130 basis points to plus 40 basis points already. So that's a 170 basis point move. And that tends to lead global economic activity by about 4 to 5 quarters. And so if you look at what's happened to global PMIs, just measures of global economic activity, they've already started to decelerate. And we continue to see that this morning, for example, we actually saw a surprise negative industrial production number in Europe, for example. And in fact, if you kind of shift what the movement in global short rates that's already occurred, so these are the monetary headwinds to continued cyclical nominal growth, and you just shift this 5 quarters forward, you can see that global PMIs are very likely to continue to decelerate through the course of 2022, and so we'll see this moderation in real growth rates. In addition to that, fiscal policy, which has been an exceptional tailwind to economic activity during the course of 2020 and 2021. We can't go through every country in the world, but these are the 2 largest economies in the world, the US on the left and China on the right. And we're already in the early stages of these so-called fiscal cliffs or fiscal decelerations, There's approximately $1 trillion of fiscal headwind already baked into 2022 in the US. We continue to see decelerations in Chinese fiscal activity. We saw some lending numbers last night that showed moderation. And so both the fiscal and monetary tailwinds that created this exceptional nominal growth rate in 2021, seem poised to fade in 2022. And again, that'll have important implications for the investment environment globally. Turning to inflation itself, so remember the two components of global nominal growth, real growth, and we're seeing the monetary and fiscal headwinds. We're beginning to see that in peaking out and deceleration in PMIs and other indicators of economic activity, still positive, but not the kind of cyclical tailwinds we saw in 2021. So many different measures of this supply chain issues. If you recall that inflation breakdown we looked at a moment ago, the big components driving inflation were food and energy and real goods. And a lot of what's going on with goods is, the supply chains are disrupted. A lot of the goods that are manufactured in Asia are obviously having trouble reaching the US. And while Omicron is creating some, continued challenges, as are, other kinds of idiosyncratic factors, peak congestion, the really most severe congestion, this is an aggregation of a whole variety of different shipping indicators that's prepared by Citigroup. So it's just one of many different approaches to analyzing this. But, it seems like we're passing the peak of the most severe supply chain disruptions. And as we pass through the current Omicron wave, we'll probably see incremental moderation. It's interesting to note that retail inventories and other measures of inventories are actually up recently. And so if we see any moderation in demand, the kind of pressure on things like used auto prices and apparel that are still evident could moderate pretty quickly. Other volatile contributors to inflation, again, food and energy were critical contributors to the breakdown of that 7% print. Interestingly, this morning's headline inflation number showed energy finally turning into a slight moderating effect on inflation, as oil prices are now anniversarying the surge off that extraordinary negative $40 number that we saw during the middle of the COVID crisis, with, again, all kinds of disruptions to the energy markets. And then food price inflation, really important. A lot of components, some things that people don't follow as closely, like pork prices, which is very important in Asia, but real moderation in the inflationary pressures from food. In fact, for those of you who follow markets very closely, you might be aware that China posted a CPI number last night that was a surprisingly moderate number, the lowest in 13 months. It was 1.5%, and one important reason was this moderation in food prices. So the inputs to inflation beginning to moderate, even as sentiment and consensus has turned very bearish. Axiom, as you know, is a very active, has a very active process for monitoring economic data globally. So as a team, we rate economic releases for about 100 different countries every single day. So we aggregate all of that data into national indicators of inflation and economic growth and national balance sheets. We consolidate that into these regional heat maps, and then we roll it up on a rolling 13-week quarterly cycle into aggregate indicators of global growth and global inflation. So, we'll very actively monitor how these monetary and fiscal headwinds, how these input prices and so on are unfolding, in order to make sure that we align the portfolios with the most current data. But just to look at what we're actually seeing in real time, growth continues to be positive, but and this is, again, this rolling 13-week view of the aggregation of essentially 10,000 economic data points globally, covering all major developed, emerging, and frontier countries. That really peaked out last summer. And while it's still positive in Axiom's parlance, a 0 plus, it's past the period of maximum acceleration. It's now into a kind of a more stable growth or moderating period. And with respect to inflation, we do continue to rank inflation negatively. So the current data has not improved. In fact, we've ranked inflation negatively for nearly the last 40 weeks. But it's no longer getting worse. It's just staying at an elevated level. And in fact, kind of taking a very close look at the most recent data, there are actually some underappreciated hints that we may, in fact, see an unexpected moderation of inflation during the first half of 2022. So just looking at a couple of recent data points that on the left, you can see some of the data points that I'm just going to highlight. And then on the right, just some recent screenshot of some of the data points that we've captured in Axiom, our research database. And these are fundamental data points, entered by the portfolio management and research team and evaluated as part of our daily meeting and so on. And that's what's rolled up into those heat maps and those rolling 13-week indicators of inflation and growth and so on. But just addressing two important recent data points. So, China is still the factory of the world. A lot of goods are made in China and exported, and input prices into Chinese manufactured goods, so Chinese input PMI prices, tend to be a leading indicator with a 1 to 2 quarter lead for particularly US CPI, but CPI outside of China more broadly. And as you can see, one of the surprise things that happened in November and December is Chinese input prices really showed a moderation. And in fact, last night we got Chinese headline PPI, and while it was still elevated, it came in a little lower than people expected and showed the first sign of moderating in quite a while. So when these input prices moderate, a couple of weeks or months later, those goods get exported, and those result in a moderation in the prices experienced by US consumers. So it tends to lead, peaks in Chinese input PMI tend to lead peaks in US CPI. Similarly, down below, we actually just saw this even in goods that are made now in the US, so ISM input prices. So again, this cost of goods has been an important inflation driver alongside food and energy, and we've already seen those prices moderate as well in green. And again, that tends to lead US CPI. And it's very rare that you'll see a moderation in these input prices and CPI not follow. There have been other hints of moderating inflation. Some of the other manufacturing economies in Southeast Asia, like Thailand, Philippines, Vietnam, where a lot of goods are now made, are showing moderating inflation. And in fact, we've even seen in the most recent regional Fed surveys some hints of prices beginning to moderate. So we're still ranking inflation negatively, but there's clearly, increasing evidence that we'll see a moderation in the first half of 22, which will again have implications for growth and value and stock selection. What this means in terms of aggregate earnings growth, just again transitioning to the bigger picture, we had this exceptional period in 21 on the back of that 10% global nominal growth rate, where global corporate earnings, particularly because of recoveries in some of the cyclical sectors like energy and materials and traditional banking, showed very robust recoveries off depressed levels in 2020. But with those tailwinds now moderating, expected earnings growth is likely to moderate again. And that, of course, is consistent with our medium and longer term structural case for growth, which is that corporate earnings growth is increasingly scarce given the totality of forces in the world at the moment. And those forces, those headwinds to global nominal growth, have actually been intensified and reinforced as a result of what happened during COVID. So for those of you who haven't had a chance to watch our 4Ds webinar on the structural case for growth, there are demographic headwinds. There's this moderation in demographic growth globally that's actually intensified and accelerated during COVID. So birth rates are actually falling even below the pre-COVID levels. That's going to restrain global nominal growth. There are debt overhangs as a result of the excessive fiscal policy of the post-financial crisis period. That means these fiscal cliffs and these fiscal headwinds to growth are only going to intensify as those imbalances have to be funded. There's deglobalization and regionalization of trade. We all know what happened during COVID with all of the supply chain problems that are continuing to characterize markets to this day. And as global trade moderates, that tends to restrain global nominal growth rates. And then finally, the effects of disruptive technologies mean that traditional business models are losing their core profit pools to innovative alternative competitors. And so the available pockets of, available growth is getting concentrated into fewer and fewer hands. And so that all is consistent with this idea that as nominal growth moderates, we'll see a resumption of the structural growth markets. And in fact, just on a microeconomic level, so this is kind of more of a top-down view. On the right-hand side, you can see a measure of global estimate revisions, and this actually goes back quite a long way, several decades. And you can see just as, we're seeing these fiscal and monetary headwinds and some of the moderation in global nominal growth rate, we're seeing a moderation in the aggregate estimate revisions, consistent with the idea that some of the companies that have really benefited from the policy tailwinds are beginning to moderate their performance. Again, I think that's good for the kinds of dynamic growth stocks that Axiom focuses on. One last comment just on the overall environment entering 2022. Of course, there are always concerns about equity market valuations. It's worth just recognizing that the strong earnings growth during 2021 meant that in aggregate valuations on earnings and cash flows and so on actually didn't go up. The performance was really driven by earnings recoveries, and some of the growthier sectors, including technology, actually delivered very strong earnings, as did some of the cyclical sectors. And so that just, I think, is important to recognize in terms of the equity opportunity, still above trend growth, even if it's moderating, and valuations that, didn't really necessarily get extended in 2021. Just turning to Axiom's performance in 2021. First a comment on markets generally, and then just a review of how we did. So generally, markets were positive in 2021, particularly developed markets, and so you can see here a breakdown: developed, all country, and emerging. And this is for the all capitalization, so not just the small caps. This is all caps. So really, developed markets led performance up over 20%. If you look at all country, EM and DM together, still very strong, nearly 20%. But EM itself had a tough year, down 2.5%. And if you look on the right, if you look at the top and bottom performing countries globally, while there were several emerging markets that did quite well, including in the Middle East, China was really the standout weak market, down over 20%. With the combination of policy headwinds and COVID disruptions, and that really weighed on emerging markets. Emerging markets ex-China would have been up 10%, just to put it in perspective. In terms of sectors globally, as mentioned, there was a cyclical recovery. Remember, oil was, for example, anniversarying that negative oil price print that we saw during the middle of the COVID crisis. And so in the context of that recovery, energy actually was the top performing sector. And, several of these other cyclical value sectors, real estate, parts of financials did well. There were opportunities for dynamic growth investors, including in technology, healthcare, and the consumer sectors, the specialized industrial. So but again, some of those value sectors really standing out. What that meant in terms of looking at the style performance globally, it was a year where value recovered, helped by the high nominal growth rates. And so in developed markets, the effect was less pronounced. It was about 80 basis points outperformance by value, so nothing too serious. If you look at all country, developed and emerging together, about 250 basis points to value. So again, moderate outperformance by value. But in emerging markets specifically, a very strong value rotation, with the cyclical stocks having a very strong start to the year and during the first couple months of the year, and then the policies against the platform internet stocks in China in particular really hurting the growth benchmarks in emerging markets. So 1,240 basis points rotation to value during the course of 2021. What that meant for Axiom's all cap strategies is we were broadly able to navigate a value-oriented market. So despite the policy headwinds, which are always a challenge for bottom-up growth managers, and despite some of the headwinds to growth investing, especially in emerging markets, our all capitalization strategies were generally able to put up solid alpha, including an international, global, concentrated global growth. And then within emerging markets where the headwinds to growth investing were severe, so I just put in the growth benchmark for reference. You can see down 8.4%, added a lot of value relative to growth and performed close to benchmark in our dedicated core emerging market strategy, and then in our emerging market world strategy, where we have the flexibility to own some of the emerging revenue stocks that are domiciled in developed markets. We're able to navigate and use that lever to outperform the benchmark. But broadly speaking, all cap strategies did well despite the value rotation during 2021. And we do feel that markets are going to be more favorable as 2022 progresses, not necessarily in the first couple of weeks, but as the year progresses. Taking a longer term view, again, consistent with 4D's framework, the structural growth framework, and I know this is very topical because a lot of people are questioning whether or not there's a more durable value rotation that's unfolding. We continue to very strongly believe that the headwinds from demographics, from the debt overhangs, the fiscal imbalances, from deglobalization, regionalization of trade, all of those things are going to restrain global nominal growth. We'll see it continue to decelerate. That'll continue to be a headwind, as it has been since the financial crisis, for value stocks and for cyclical stocks. And then on top of that, the disruptive forces of innovative technologies, which have been accelerated during COVID, the adoption of those technologies has been accelerated, will continue to represent a headwind for traditional value stocks and a tailwind for growth stocks. And so if you take a longer term view, this is 5 years, it will look the same over 3, 5, 7, 10. Growth continuing to outperform value across all of the different categories, developed, emerging, and all country. And consistent with that, and again, this would look the same 3, 5, 7, 10. Axiom able to navigate markets through stock selection and through disciplined portfolio construction and add significant value over meaningful rolling time periods across all of the different all capitalization strategies. Just mindful of time and just touching briefly on our small cap strategies. We have a really outstanding roster of small cap funds, but as was the case with the all cap markets, in small cap, there was a distinct value rotation that was especially pronounced in the US. You can see Russell 2000 value up 28 versus Russell 2000 growth up less than 3, so negative 25 points. Not everybody knows, but the value index includes, a lot of these regional banks, a lot of the smaller energy companies, and those got a real tailwind from the the high nominal growth and the policy support. And the growth index has a heavy component of some of the innovative biotech companies that were helped during 2020 and kind of consolidated in 2021. So very strong headwinds to U.S. Small cap growth, less pronounced outside the U.S., so only a 2.6% advantage to value. In terms of Axiom's performance, actually our U.S. small cap team just did a phenomenal job. Every time I see this chart, I'm personally very impressed. So really able to navigate very strong headwinds to growth investing through stock selection, especially in some of these interesting, innovative, smaller industrial and housing related companies. Be happy to talk about it another time with more time, but very strong value added within the US. And internationally, I think a real credible job of holding our own despite the headwinds to growth investing after very strong performance over the last couple years. And again, continue to believe, just moving forward, that the same 4Ds framework of demographics, fiscal imbalances, debt overhangs, deglobalization, and disruptive new technologies have structurally favored growth investing since the financial crisis and are likely to do so increasingly over the coming years and I think even decades. So if you look at both the U.S. and non-U.S. benchmarks, growth investing continued to add more value for investors over 3, 5, 7, 10, and so on. And Axiom performing accordingly with good stock selection and disciplined portfolio construction. Just turning for a moment and pausing on the current growth value rotation, which I imagine is in a lot of people's minds because it's been very intense. So what you're looking at on this page is 10 years of monthly growth versus value globally. So if the the graph is green and above the line, that means growth is outperforming. If it's red and below the line, that means value is outperforming. There have been a lot of rotations throughout all of these rotations post-financial crisis, and this is monthly. The monthly average tailwind to growth investing has been positive 30 basis points, which is to say, because of those 4 Ds, structural growth investing has been the right place to focus, even though intermittently, particularly during these moments of massive policy intervention, you get these reflationary rotations. Since the introduction of the vaccines with strong fiscal and monetary support, we've had some pretty intense months of value outperformance. We've seen 2 particularly pronounced ones in December and January. We continue to believe that the forces that really support that value rotation are already beginning to ebb, so that global nominal growth, for all the reasons we talked about earlier, will moderate during the first half of 2022. And so the kind of reopening trade that has fueled these intermittent value rotations will fade, and we'll be back into the structural growth markets. And in any event, it seems to me that the folks who are saying that value is coming back into favor are really telling you what happened, not what's going to happen. With regard to how we've managed to navigate and add value, just kind of wrapping up on the overview of 2021, Axiom continues to focus on stock selection and investing ahead of the curve by focusing on forward-looking fundamental drivers of businesses, taking a deep dive into all of the evidence, validating the integrity of that fundamental investment thesis, really benefiting from the consistency of our dynamic growth philosophy that we implement across the entire organization. So we really get the strength of the entire team collaborating to share information globally and gain insights. And of course, we're completely aligned in doing that with our clients. We're 100% employee-owned, broad participation, long-term orientation, and we continuously invest and reinvest alongside our clients. What that meant in terms of just an example of how we were able to navigate this value rotation in 2021, and just picking some high-impact stocks. So this focuses on 2 examples in China, both of which were top 10 contributors to multiple strategies, emerging, international, some of the global strategies within China, and were an important reason that in a market, China, where the benchmark, the MSCI, was, as I mentioned, down over 20%, Axiom's strategy-specific performance was typically up over 10%, so a lot of positive alpha within that opportunity set, and it does underscore the stock picking opportunities, throughout different markets globally. So on the overweight side, so as many of you may be aware, this is our investment philosophy, dynamic growth. So it's the intersection of positive change, sustainability at a reasonable price. And with regard to a positive impact stock, CATL, not a household brand name, but the global leader in the independent manufacture of batteries for electric vehicles. And so they supply all of the Chinese electric vehicle companies, and there's a very big policy push in China to adopt cleaner transportation because of all the environmental problems that characterize China. So very policy-aligned company. And back in 2020, our analyst, in this case Anna Browning, was able to really take a deep dive on all of the contracts that CATL was signing, both with the domestic companies as well as with global OEMs, including Tesla, and identify a 40% gap between where earnings were tracking and what was embedded in consensus expectations. That positive acceleration in their business was occurring on top of an already highly sustainable business model with wide and expanding moats. And so global #1 maker of these, supplier of these batteries for electric vehicles, with a global leadership position in the innovative low-cost LFP technology, where iron is substituted for nickel to make the batteries less expensive for mass adoption. And the valuation, while above market, consistent with the high and accelerating growth. So that was a stock that we rated favorably. On the other hand, Alibaba, a name that everybody's familiar with, a stock that we'd owned successfully since 2015 across different strategies, beginning actually in 2020, so not even in 2021, we began to recognize that the tailwinds that had really characterized a sustained period of outperformance by Alibaba were deteriorating, the competitive moats were compressing, and so there was rising competition from new innovative competitors using social marketing to eat into Alibaba's dominance in e-commerce. There were gathering headwinds. I mentioned ESG earlier. There were gathering headwinds to their regulatory situation that were beginning to express themselves as problems for their higher growth businesses, including in cloud and fintech. And their market share was actually beginning to compress in their core business, which really calls into question the sustainability of growth. And the valuation, while at a discount to its historic levels, was not low enough to reflect the gathering headwinds. What that meant, just turning to Axiom's rating system, again, we rank all stocks when they're first introduced throughout their holding period, both for risk and return. And as you can see, Alibaba, going back, this multi-year holding, but it entered 2020 rated a B2, which is a very attractive risk and return score, was downgraded late in 2020 to a B1, and then promptly downgraded again to a C1, at which point, and that's a combination of all of the challenges that I mentioned, we exited it in a number of the strategies for which it's a marginal holding, like international and global, and we made it a very significant underweight in our emerging market strategies. And so throughout the course of 2021, it actually became a positive attribution factor because of that avoidance. On the other hand, CATL, which was rated throughout the period an attractive C2, continued to perform very well. Just kind of concluding the overview and just giving you a sense for how this translates. So we try to get in ahead of the curve, identify these accelerations in sustainable businesses with wide and expanding competitive moats. And so in the case of CATL during the course of 2021, you can see earnings just accelerated. They actually moved up 54% through the course of the year, and that resulted in 67% share price performance because you got a little bit of re-rating on top of the earnings acceleration, as is often the case. And in the case of Alibaba, real headwinds to their business model meant that earnings actually fell 35% through the course of 2021, dragging the share price down over 50% as the stock continued to derate. In general, looking through the growth and value rotations, one thing that really accumulates, and I think the opportunity is very pronounced at the moment because there's such a wide dispersion in estimate expectations at the moment, is the stock selection opportunity through growth and value cycles. And that's been a persistent feature of all of Axiom's strategies. So looking back over the last 5 years with all the different growth and value environments, you can see the really pronounced positive selection effect throughout all of our strategies. And then in addition to that, because we tend to gravitate into areas of acceleration and improvement, that results in some positive allocation as well. Moreover, because of the attention to risk and return throughout all of our stocks and the evidence-based approach to reconfirming and re-underwriting our investment thesis, we've been able to manage upside and downside capture successfully through the different strategies, generally capturing more than the market on the upside and mitigating the headwinds on the downside. So that's just a word on both current and longer term performance. Just concluding in the interest of time, I'm mindful that time is short. A few words on an underappreciated opportunity in ESG investing that I think is very much appreciated by many of our clients. And it's the opportunity to be a part of actively advancing positive change in ESG alignment. So not only investing in good companies and avoiding bad companies, which is beneficial. And so what you're looking at on this slide is the alpha effect from different approaches to ESG. And owning good companies, sustained leaders, has a moderate positive effect on performance over time. And avoiding bad companies has positive effect by avoiding negative alpha. But the bigger, more compelling opportunity is participating in and maybe even accelerating this process of a good company becoming better, or a laggard becoming a leader and getting recognized in the marketplace, which can add over 100 basis points to alpha. And on the other hand, eliminating, as is the case with Alibaba, a leader becoming a laggard, a company going through a period of deterioration, which can cause more than 100 basis points of negative alpha. In terms of how Axiom approaches that, not only do we invest in good companies, so just using the MSCI rating system, there are different rating systems. MSCI is, certainly a leader and widely regarded. You can see all of the strategies are highly rated, A-rated overall, many of them AA rated. But maybe more interestingly and more provocatively, because of our approach to actively advancing positive change and investing ahead of the curve in companies going through a positive evolution, on average, our companies are experiencing 5-to-1 upgrades to downgrades to these already high MSCI ratings. And so we are actually tracking in our actual research database thousands of ESG related data points. Run rate is now over 4,000 based on the most recent quarterly total. We're having, it's 175 engagements during the course of 2021. That's now actually run rated over 300. So very actively engaged with companies to help them identify specific opportunities to make targeted improvements, and then communicate those improvements to the marketplace to get recognized and to get that alpha tailwind. We have a very active process for integrating this with our proxy voting, and where appropriate and necessary, we will vote against management in order to reinforce the need to advance these positive changes. Again, many of our clients appreciate the fact that not only do they get the performance benefit, but they can actively participate in this advancing of ESG alignment. And then, throughout the course of 2021 and into 2022, there are many examples of specific concrete targeted engagements, whether it's Axiom filing 14A8 proposals, direct proxy proposals to nudge companies into action, or collaborating with other investors. So with that, I will pause. I can see Matt is calling time.
Thanks, Andrew. We have now reached the end of our prepared remarks, and we do realize we've gone a little long, but we have a number of questions that have come in, so we'll go ahead and dive right into those. The first one is an interesting question. You've touched a little bit on this as you've gone through your prepared remarks, but it just says, we are currently experiencing a violent market rotation that started late last year and continues into this year. How long do you think it will last, and what positioning changes are you making? Sure.
So again, that gets to the growth value chart that we looked at with a very pronounced 2 months of value rotation that's really been catalyzed by kind of a belated but now very intense concern about the current inflation print, the 7% inflation print that we saw today. And as discussed, we see a whole variety of indicators in our macroeconomic monitoring, and I shared the heat map and 13-week rolling trends that suggest to us that we will see a deceleration in those nominal growth tailwinds that have really catalyzed the current value rotation, and the underlying structural growth market drivers, the 4Ds, reassert themselves during the course of the next couple of months. And so, it's our view that the opportunity is really to refocus on growth stocks, which have consolidated now. We've seen other rotations like this. I pointed out a few when I showed that slide, 2018, 2016, and as was the case then, we anticipate that compounding from the growth stocks, which continue to generate higher sustained structural growth, will be the dominant feature of performance in the coming quarters and years. So, it's our, again, we're very evidence-based. We'll continue to monitor the evidence. We see some green shoots, but it's certainly not how we're ranking the aggregation of the data yet. But we expect that that'll become in evidence during the first half of 2022.
Great. The next question is, what is your biggest macroeconomic concern, and how have you mitigated it in your portfolio?
Sure. My biggest concern is that we have really damaging policies that disrupt, productive investment in innovative new technologies that can enhance global productivity and really lift both corporate earnings, but we'll say, economic well-being globally. And so to the extent that we have policies, even if they come under very attractive rhetoric like common prosperity in China, so very attractive rhetoric, common prosperity, who can object to that, but really it's an authoritarian move to try to seize control of the most innovative parts of the economy and effectively have the consequence of inhibiting investment in these productive new technologies. Those kinds of initiatives, I think, are the most concerning to me. I think that national banks moderating monetary policy to respond to the current inflationary impulse, that's not a bad thing. I think ultimately that's a good thing for stock market investors and for growth investors to navigate those risks. And again, we were able to underweight China in a timely manner by being proactive and recognizing those gathering headwinds. There have been other examples. We very closely monitor not only the microeconomic but also the macroeconomic context for all of our investments, and reflect that in our forward-looking risk ratings and adjust portfolios accordingly.
Fantastic. The next question here, and you alluded to this a little bit as you were going along when you were talking about EM growth, but everyone knows that it's had a challenging year in 2021. And how does that change in 2022? And kind of as a follow-on, what themes, maybe countries and sectors do you find most interesting in the coming year?
Sure. So, EM's, I think, a particularly interesting opportunity at the moment. As I mentioned, the structural opportunities within emerging markets have actually really improved over the course of the last decade. And I think that's part of the reason that even in a challenging environment like China in 2021, we were able to find some pretty high impact positive performers. The emerging markets are increasingly dominated by some of the more innovative sectors. So you see a rising importance of the consumer sectors, of technology. We believe you'll continue to see healthcare rise in the benchmarks, and those will continue to displace some of the, I would say, lower quality, more cyclical sectors like energy and materials, and that creates very interesting stock selection opportunities within emerging markets. Emerging markets represent the overwhelming majority of the global population, upwards of 80%, more than 90% of people under the age of 30. You'll continue to see, as a result of that, higher growth in emerging markets. So more interesting stock selection, higher growth, and the valuations, of course, have now set to historically attractive levels. And so that combination seems promising. In terms of specific areas where we found opportunity, as mentioned, you have these very large and rising Asian middle class. Healthcare still only represents about 5% of GDP in many of those large economies, in certain cases even less. So innovative providers of health services and healthcare equipment see a lot of structural tailwinds, and there can be pretty wide and expanding competitive moats, and so that's been an area of opportunity. Technology, we now have global leaders, everything from TSM and Samsung to one of our interesting holdings. Infosys in India put up another great quarter just today, really enabling the digital transformation of economies around the world because they have those specialized workforces and they have structural competitive advantages. And then, these domestic consumer champions, we found interesting opportunities, for example, in athleisure in China of new emerging local companies that are capturing share, partly as a result of nationalism and partly as they move up the value chain. So we'll look for those kinds of, I think, really interesting pockets of growth.
Great. Well, I still have several questions in our queue, but let's take time for one more question, and this one's kind of a longer one. So I'll just go ahead and read it. It says, some believe that after such a long period of outperformance for growth, value is just getting started. Is this the end of the growth era? And many growth managers have performed particularly well in the past several years. How do you distinguish your investment approach and performance from other growth managers?
Sure, I'll take that as a two-part question. First, I'll talk about growth versus value, and then I'll talk about Axiom. So with respect to growth versus value, let me just say we have a webinar on this topic on our website called the 4Ds. But briefly, if you take a very long-term perspective, value outperformed growth for the 75 years between World War II and the global financial crisis in 2008, 2009, because throughout that many decade period, there were demographic tailwinds to growth that lifted some of these traditional business models. There were this general trend towards debt accumulation and expanding fiscal policies globally. So there were tailwinds to fiscal spending, which brought forward consumer activity. There was a long period of rising globalization, which accelerated global real GDP growth, and technology adoption was still, it was a persistent feature, but it was not at the pace that we see over the last decade. And so, during that long multi-decade period, you wanted to structurally own value, and periodically, vacation and growth was the term. That all changed, frankly, around the time of the global financial crisis. All of those features, demographics, fiscal imbalances and debt accumulation, deglobalization and regionalization of trade, and then the accelerating effect of technology have all really concentrated. On the one hand, they've restrained global nominal growth, and on the other hand, they've really concentrated the growth into the limited number of companies that are well positioned to really exploit innovative technologies to capture those profit pools. And that's why, really since the financial crisis, there's been a persistent tailwind to growth investing. Doesn't mean we don't have these intermittent value rotations typically associated with aggressive policy intervention, such as we saw during COVID. But as those policies inevitably moderate, as they already are, we return to the underlying structural tailwinds to growth, and that's our expectation. And so I think this is a great opportunity for people to crystallize whatever relief they've had in their value investments and, refocus them on the structural dynamic growth companies that are likely to perform for the years and decades to come. With respect to how Axiom differentiates itself, there are a number of features, but just to highlight a few, it is a fundamental forward-looking investment thesis approach, and so we're bottom-up stock pickers driven by an ahead-of-the-curve focus on companies that have not only wide and expanding moats, but where there are clear accelerations in their businesses that aren't reflected in consensus, and so it's very catalyst-rich. We are fact-based investors, and so we have an extremely robust process for gathering, integrating, and re-underwriting our companies on a continuous basis. We have a risk and return framework, which means that we navigate different kinds of market environments over rolling time periods because of that attention to portfolio construction. And then finally, we're an extremely collaborative organization. It's one philosophy, one team, a partnership, all implementing this shared philosophy, all using these shared risk and return tools and research databases, which means we really amplify the effectiveness of the entire organization.
Thanks, Andrew. Well, I think that gets us to the end of our time. If we haven't had the chance to answer your question, a member of our client partnerships team will be happy to follow up with you individually. But again, I just want to thank everyone for participating today. And we are so appreciative of the trust that you place in Axiom. And thanks again for joining. And we hope you'll join us again next quarter.
Thank you.